Chapter 7, Understanding Credit Scores. Credit bureaus. On each of the lending paths in this book, I have discussed the importance of credit. You heard me mention credit as a compensating factor for each product mentioned. I have emphasized it heavily on the credit-based lending path because it is one of the primary factors used to determine approval in terms of the funding. But again, it is still a compensating factor for every product mentioned in this book. The lender will always consider your credit. So I think its own right, we cover what truly affects your credit. There's so many myths out there as to what affects your credit. There is so much misinformation by so many of your favorite gurus. And one that is really popular is Dave Ramsey, who is a very popular financial advisor who simply just does not get the importance of credit and how credit works and how it's calculated. One of the messages that Dave Ramsey preaches is about how to stay away from credit cards, which I think his message is misconstrued. I'm sure his message is to teach people to stay out of debt, but the way he chooses to do this is by coaching people not to have credit cards. I understand his message, but Mr. Dave Ramsey, or I did not come up with the FICO scoring algorithm. And there is no way you can have a good credit score without having credit cards. This is simply a fact. And we'll get more into detail and prove my point about this later on in this chapter. But it gets under my skin when I hear him and a lot of so-called financial advisors that do not understand FICO scores and how they are calculated. They mislead millions of people, and I do not want you to be misled anymore. Let's spend some time in this chapter discussing credit bureaus, FICO scores, paydex scores, and just everything credit. There's an old quote by Mr. Darrell Brown I mentioned earlier, which reads, "If you want to impress people, make things complicated. If you want to help people, keep it simple." This is my mission with this book. Clearly, the credit bureaus have tried intentionally to complicate credit, and the misinformation from these so-called financial gurus does not help either. So I'm glad you are reading this book, The Business Funding Resource Bible. I challenge all these financial experts to prove me wrong with all my concepts and ideas I have laid out here. But anyway, with that said, let's get to the nitty-gritty on credit scores, and credit bureaus history. Now, I am not going to sit here and waste your time with a bunch of old dates and some old dead people's names that I know you don't really care about. I am going to get straight to the point as to what you need to understand. The concept of credit bureaus started a long time ago. I believe it dates back to 1899 or something. If memory serves me well, it started in Atlanta, Georgia, by a guy named Guy Wolford, who founded the retail credit company, which eventually became Equifax. But his main objective was to go around and gather information about consumers' credit behavior, which banks and credit companies and lenders use to make their decision. To be clear, he did not invent the concept of credit. The concept of credit dates back to the Babylon days, and period. He came up with a method of gathering information and centralizing the data for lenders so we can speed this up. As you know now, there are three major credit bureaus: Equifax, Experian, and TransUnion. There are other small ones out there, but these are the three major bureaus you need to be concerned about. As time went on, and with the industrial age booming, where people were moving from rural to urban areas and people were opening bank accounts, getting loans, the American dream of homeownership was being pushed and shoved down everyone's throat. Banks needed a better, faster, and convenient way to evaluate and analyze risk. Before, the bank would review all the reports being provided by the bureaus, and they would manually evaluate these files to determine risk. If you think about that, a major bank like Chase, B of A, Wells Fargo, or even your local bank taking thousands of applications daily. It is almost humanly impossible for them to accurately evaluate each of the reports being offered by the credit bureaus. Also, there a few things that come into play as to how it would be impossible at the same time period. You had a lot of discrimination laws on race and gender that banks needed to make sure they were compliant with. I always say you can make whatever law there is out there, but it does not change people overnight. In short, if a bank associate or manager is racist or sexist, no law will change that. In 1956, there came a company called FICO, which stands for Fair Isaac Corporation, formerly known as Fair Isaac and Company. What they did is come up with a scoring algorithm, also known as equation, using the information being held by the major credit bureaus. they would be able to come up with a score which would range between 300, 800, 50 or 3, 800. And basically, if someone had a higher score, they would be considered low risk. And if someone had a low score, they would be considered high risk. As we get more into this chapter, I will discuss what affects your score. But it's important to understand that brief history. Now, there are numerous credit bureaus, but the main ones you need to be concerned with are Equifax, Experian, and TransUnion for personal credit, and Equifax, Experian Business, and Dun Bradstreet for business credit. There are a few scoring algorithms out there, but the ones you need to focus on is the FICO scoring algorithm. More than 90 of lenders use FICO scores and have been for more than 50 years, and I do not see this changing anytime soon. In this next section, we will expand on each one of the 5 factors that FICO evaluates. Let me be clear. These are just not my thoughts like what you hear from Dave Ramsey or any other so-called financial expert. This is coming straight from the source. Simply go online to FICO's website and you will see the same scoring algorithm explained as to how their scores are generated. As I said, I am not here to mislead you. I'm here to simplify the lending process for you and empower you with the knowledge you need to make informed decisions. So keep in mind, there are 5 factors that affect your credit score. 1, payment history. 2, utilization. 3, age of file. 4, types of credit. 5, inquiries. So now let's expand on exactly what each one of these factors is evaluating. I will also explain what each of these factors are by defining them. Secondly, I want to explain to you how they affect your credit negatively and how they affect your credit positively so you can truly wrap your head around how the score is calculated. 35, payment history. Payment history evaluates how a borrower's track record of making payments on time. It is just that simple. But the key thing here is you have to have some line you are making payments on time that is being reported to the credit bureau. Examples of things that do not automatically get reported to the credit bureaus are rent payments, utility payments, child support, etc. I have a client of mine who is a farmer, and commonly farmers pay everything in cash. They say during consultations when I inquired about credit, "Oh, Brian, I should have great credit. I pay everything in cash." This is my point, and is one of many misconceptions that people have. I jokingly always say, a credit bureau is not owned by God. If the trade line or transaction is not reported to the bureaus, you will lack payment history. So how can this affect you positively? Make sure you have trade lines on your report that are being reported monthly to benefit from this 35 of what FICO evaluates. Now, how can this affect you negatively? Well, not making your payments on time will lead to late payments, charge-offs, collections, judgments, liens, bankruptcies, and so on. So to summarize, understand that 35 of your credit score is based on payment history from trade lines being reported to the credit bureaus. 30, utilization available credit. Now, let's take some time to discuss the second biggest slice of the pie, the 5 factors, which is available credit, or also known as utilization. This is a calculation of balances in relation to the limit on all open revolving accounts. Let me repeat it in a different way. Utilization is balances divided by the limit on all open revolving accounts. Example, if you have a Capital One credit card with a $1,000 limit and a $500 balance, you are 50 utilized. The key word here is revolving accounts, meaning credit cards. Credit cards are the only type of account that gives you access to credit, aka available credit. I mean, really think about it. Your student loan, auto loan, mortgage loan, equipment loan, none of these being reported on your credit give you access to credit. As a matter of fact, I bet you probably never even saw the money. If you got any of these other types of accounts, the funds go from the bank to the vendor and you get the product and a monthly bill. So to be clear, the only way you can benefit from 30 of what FICO evaluates is by having credit cards, while Mr. Dave Ramsey is lying to people on a daily basis that they do not need credit cards. And what really irritates me about Dave Ramsey is he has a net worth of almost $500 million. I mean, clearly, he does not need credit cards. He is beyond rich. He is wealthy. What he needs to tell people is to stay away from large credit card debt, not to get rid of the credit cards. But most people reading this book are not wealthy. Most people are in the process of building their wealth. And as explained in this book, credit cards can be a great tool to building your wealth and one of the key benefits helping you maintain good credit so that you can get attractive loan offers. It's a fact that 30 of your credit is based on credit cards. and credit cards alone. They are the only type of account that gives you access to credit. If you actually combine 35 payment history and 30 available credit, you can actually control 65 of your credit score with just having credit cards. So now let's understand how this factor affects your credit negatively and also how you can benefit from this factor and how it affects your credit positively. The way this will affect you negatively is if your balances are too high and almost to the limit. Example, if you have a Capital One credit card with a $900 balance and a $1,000 limit, you are 90 utilized. The goal is to maintain a low utilization. Okay? Now that you understand how it can negatively impact your score by having high balances, now let's discuss how it will positively affect your credit. You will notice if you maintain your revolving accounts below 50 of the available limits, you will always have a high score. Ideally, when you are looking for financing, below 30 is what I recommend you lower your revolving accounts to. There is a joke I always say, which is lenders lend money to people who don't look like they need money. So when you are seeking financing to benefit from this factor, lower your balances. If this is not an option, you can always request a limit increase at least once every 6 months. The goal is to always have your limit increasing to the point that you can maintain higher balances without affecting your utilization. 15, age of file. Now let's discuss the third factor that affects your credit, which is the age of the file. 15 of your credit score is based on the age of the file. To be clear, this is not how old you are. We are not talking about your age or your birthday here. We are talking about the oldest trade line or item reporting on your credit report. So you want to always make sure you create a long credit history. This affects you positively in that the longer your credit history, the more you benefit from this 15 of what FICO evaluates. I just want to throw in this bonus tip here. But for more tips like this, visit www.3pathsoftlending.com. Think about every single type of account you have. There eventually will be an end date, the last date you make the payment from your student loans, auto loans, mortgage loans. You want to make that final payment. I'm sure most of you can't wait to pay off these accounts. But what type of account does not have an end date and stays open forever? Credit cards, even when you pay off the credit card to zero balance, your account still stays open. Again, I am coming back to credit cards because clearly, as you can see here, they are a powerful tool on how to manage your credit and what Mr. Ramsey and others just simply don't get. It will also give you more tools on how to manage your credit cards on www.pathsoftlending.com. I mean, now you have 35 payment history, 30 utilization, 15 that is now 80 of your credit profile that can be managed by simply managing your credit cards. I can't emphasize enough how important credit cards are. 10 types of credit or credit mix. People with high credit scores often carry different types of accounts, which might include credit cards, car loans, student loans, mortgages, or other credit accounts. This will often just happen naturally. Credit scoring models. Consider the types of accounts and how many of each you have as an indication of how well you manage a wide range of credit products. How this affects you positively is the more diverse your credit profile is, the more you will benefit from this factor. Of course, the fewer types of accounts you have, the less you will benefit from this factor. 10 new credit or inquiries. The last factor that affects your credit is inquiries. I'm going to start off with my famous quote, banks only lend money to people who don't look like they need money. If you have a lot of recent inquiries, you look desperate. Inquiries are when you fill out an application for financing and the lender requests a copy of your credit report. You want to keep lender inquiry posed at a minimum. This factor affects you negatively if you have a lot of inquiries. Too many accounts or inquiries can indicate increased risk, and as such, can hurt your credit score. Why the score is different, and what the hell is a good score anyway? I get this question often. People ask me why the score is different with each bureau. If they all have the same information, I may be asked, why are my scores different when I look online than the score I was told at the bank? Or why is my score on this website different from this website? Some people just simply want to know, what is a good credit score anyway? I want to take an opportunity here to explain to you why you keep seeing different scores. Now, let me try to answer the other question as to why scores differ. There are different credit scoring models that calculate the 5 factors we just talked about. And there are also multiple versions of the different scoring models, which are designed for specific industries. Basically, the credit scoring model, the version used in the mortgage industry, is not the same one used in the auto insurance industry, which is not the same as the one used in the credit card industry. This is also not the same scoring model version used in the auto loan industry. So it's important when you are comparing credit scores that you compare apples to apples. You have to consider which scoring model was used to calculate the score, which industry version model was used, and which credit bureau data was the credit score derived from, since the score does differ based on the bureau's data. Also, what are the highest and lowest scores you can get using that specific scoring model, since the score range could differ as well. Let me go over a few of these score ranges to make this explanation make sense. For example, in the auto industry, they use the FICO Auto Score range, which is a score designed by FICO to be used in the car financing industry and structured and tailored to predict the risk of default, specifically on car payment defaults. The score range for this model ranges from to, of course, the higher the score, the lower your risk. FICO Bank Card Score Range is another scoring algorithm that is used by credit card issuers. This score is customized specifically for lenders that issue revolving credit. It is fine-tuned to predict the risk of default, specifically on credit card payments. It also has a score ranger to EBU. Then you have the FICO Mortgages score, with the majority of lenders that underwrite mortgages using this scoring algorithm made by FICO. This specific score ranges between an EE, and it is an industry standard in the mortgage industry. It is what I would say is required for all mortgages. Actually, Fannie Mae and Freddie Mac, the largest purchasers of mortgage loans, require this scoring model to be used on all mortgages they purchase. Keep in mind that each credit bureau, TransUnion, Experian, Equifax, has its own version of each one of these scoring ranges. And hopefully, I was able to clarify why you see different numbers on your score. But keep in mind, regardless of the scoring range being used to calculate the score, it is still based on the 5 factors we covered. Payment history, utilization, age of file, inquiries. Let me help you understand what a good score is. First, I refer you to the chart below to better explain what poor, fair, good, very good, and excellent credit is. It is simple. Lenders want to feel comfortable lending money to consumers who will repay their debts as agreed and on time. If lenders feel they can rely on you to do that, they consider you to be lower risk and you will have a high credit score. The 5 factors are designed to predict your past history. Now, keep in mind, credit reports and credit scoring algorithms are just a tool that lenders use to analyze risk. There is no general law that must be followed by all lenders. Every lender has its own criteria for managing risk. Some lenders have a much lower threshold and risk, and some lenders have a high threshold for risk and have products for even consumers with low credit ratings, if the consumer is willing to pay a much higher rate. Also, keep in mind, credit scores fluctuate monthly. They are not a permanent score. They are a snapshot of the moment in your credit history. So taking the knowledge you gain from this book and managing your credit properly from now on will always certainly guarantee you the best financing options and terms.